Most people think retirement is a guarantee if they just save enough. But here's a reality check: it's not that simple. Did you know that 1 in 3 Americans has less than $5,000 saved for retirement? And even worse, nearly half of retirees could outlive their savings. That's right, half. With inflation rising, bonds barely keeping pace, and healthcare costs skyrocketing, your chances of running out of money are higher than ever. In this video, we're going to break down the shocking reasons why most people may never truly retire. But don't worry, it's not all bad news. You'll also learn smart strategies to fight back, avoid common traps, and actually retire comfortably. We'll expose the dangers of inflation, the illusion of safety in bonds, and why chasing high dividend yields might ruin your portfolio. So if you think you've got retirement all figured out, think again. Stay tuned to find out what you really need to do to make sure you're not part of the statistics. Let's dive in. Chapter 1. The Silent Wealth Killer. Inflation's hidden grip. We often hear about inflation in the news, but do we really understand its long-term effects on our retirement plans? Inflation is like a silent thief. It slowly eats away at your wealth, making everything more expensive while your savings stay the same. For example, if inflation rises by 3% annually, the purchasing power of your money will be cut in half in just 24 years. That's a scary thought for someone planning to live off their retirement savings. Many retirees assume their nest egg will be enough. But they rarely account for how inflation compounds over time. What costs $100 today could cost $181 in just 20 years. This is what makes inflation so dangerous. It's predictable but still underestimated. A 2020 study by Morningstar showed that retirees who ignore inflation are 40% more likely to run out of money during their retirement years. One strategy to fight inflation is to invest in assets that grow faster than inflation. Stocks, for example, have historically returned 7–10% annually, easily outpacing inflation in the long run. According to Warren Buffett, inflation acts as a gigantic corporate tapeworm. He's right. If you're not outpacing it, it's eating you alive. Investing in inflation-protected securities, like TIPS, Treasury inflation-protected securities, is another option. They're designed to keep pace with inflation, but their returns are modest. Real estate and commodities like gold are also inflation hedges, but they come with their own risks. You have to find the balance. Without this awareness, inflation will quietly ruin your chances of ever retiring comfortably. Chapter 2. The Illusion of Safety. Bonds and fixed income pitfalls. Bonds are often seen as the safest option for retirees. After all, they offer fixed returns and are less volatile than stocks. But here's the kicker: while bonds might protect your money from market crashes, they can't protect you from inflation. In fact, bonds could be making your retirement riskier without you even knowing. Let's break this down. In the 1980s, the average bond yielded around 8%. Today, the yield is closer to 13%, which barely beats inflation. According to Vanguard's research, the real return on bonds has been steadily decreasing over the last 2 decades. And if you're in retirement, relying on bond income that's barely keeping pace with inflation is a huge risk. A major issue is something called interest rate risk. When interest rates rise, bond prices fall. And when inflation is high, central banks often raise interest rates to cool it down. This creates a double whammy for bondholders: low returns and falling bond prices. As famed investor Howard Marks says, low returns are a big risk, especially when you rely on that income to live. To offset this, some investors turn to bond mutual funds or ETFs, but even these options offer limited protection. A better strategy is to diversify into dividend-paying stocks or real assets like real estate, which can offer higher returns and a hedge against inflation. While bonds might have a place in your portfolio, don't overestimate their safety. Too much reliance on them could cost you your retirement. Chapter 3. Dividend disasters. Why chasing yield can cost you. At first glance, dividends seem like the perfect retirement strategy. Why not live off the income from your stocks, right? But there's a dangerous trap lurking in dividend investing: chasing high yields. Many investors are drawn to stocks with high dividend payouts, thinking they're getting a great deal. But high yields often come with high risks. A 2021 report from MSCI found that companies with unusually high dividend yields tend to underperform in the long run. This is because those companies are often in trouble. They might be paying out too much to investors and not investing enough back into the business. Eventually, they cut their dividends, causing the stock price to plummet. It's a classic value trap. For example, during the 2008 financial crisis, many banks had high dividend yields. Investors who piled into those stocks for the dividends got burned when the banks slashed payouts. The same thing happened during the pandemic in 2020, when several oil companies cut their dividends due to falling demand. The smarter strategy is to focus on companies with a solid history of consistent, moderate dividend growth. Warren Buffett's Berkshire Hathaway, for example, prefers to invest in companies like Coca-Cola and Procter & Gamble, which have steadily increased their dividends for decades. These companies reinvest in their growth while rewarding shareholders with reliable payouts. Also, reinvesting dividends instead of living off them can supercharge your returns through compounding. According to a study by Hartford Funds, dividends contributed nearly 40% of the S&P 500's total return over the last 90 years. So, it's not just about the dividend itself, but the growth potential of those dividends. Before we move on, hit subscribe and let's dive back into more great content. Chapter 4. Outlasting the market. The longevity risk no one talks about. Most people plan for retirement based on how long they think they'll live. But here's the thing, people are living longer than ever. According to the CDC, the average life expectancy in the US is around 79 years, but many retirees are living well into their 90s. The problem? Most retirement plans don't account for this. You could easily outlive your money if you're not careful. This is called longevity risk. It's the risk of living longer than your savings last. A 2022 study by the World Economic Forum found that the average retirement savings gap could be as much as $400,000 for someone living 20 years past retirement. That's a huge shortfall. It's easy to underestimate how much you'll need when you're 65, but what happens when you're 85 and still going strong? One way to manage this risk is to delay your retirement. The longer you work, the more you can save, and the fewer years you'll need to draw down your savings. Even delaying Social Security benefits can increase your monthly payments significantly. According to the Social Security Administration, for every year you delay taking benefits past 62, your monthly payment increases by about 8% up until age 70. Another strategy is to create a retirement plan that includes multiple streams of income. This could mean investing in rental properties, dividend-paying stocks, or even an annuity. Annuities guarantee a fixed income for life, but they're not for everyone. The key is to have a safety net for those extra years you didn't plan on. Diversifying your portfolio is also critical here. A study by J.P. Morgan found that retirees with a diversified portfolio that includes equities are 35% more likely to maintain their purchasing power throughout retirement. So, while it's tempting to go conservative with bonds and cash, don't forget about stocks and other growth assets. They're your best defense against outliving your money. Chapter 5. Compound returns. Your best friend. If you start early enough when it comes to building wealth, there's one rule that's more important than any other. Start early. The earlier you invest, the more time you give compound interest to work its magic. Albert Einstein famously called compound interest the eighth wonder of the world. And he was right. The power of compounding can turn small, consistent investments into a substantial nest egg over time. Let's say you invest $10,000 at a 7% return. After 10 years, that investment grows to almost $20,000. But here's the kicker, after 30 years, it grows to over $76,000 without you adding another dime. That's the magic of compounding. Time does the heavy lifting. But here's the catch, most people underestimate how much they need to start early. If you wait until your 40s or 50s to begin investing, you've missed out on decades of potential growth. A 2018 study by Fidelity showed that investors who start in their 20s can retire with almost twice as much wealth as those who start in their 30s. The difference is staggering. One strategy to maximize compound returns is to automate your investments. Set up automatic transfers into a diversified portfolio of stocks, bonds, and other assets. It takes the emotion out of investing, ensuring you're consistently contributing over the long term. Also, reinvesting dividends accelerates the compounding process. According to Hartford Funds, investors who reinvest dividends see an average return of 9.7% annually, compared to 6.7% for those who don't. Another tip? Don't panic during market downturns. The S&P 500 has historically recovered from every single bear market. Staying invested during the tough times is critical to compounding success. The real wealth comes when you let time and compound interest do their job, uninterrupted. Hit subscribe to support our channel and be the first to see new videos.